Let's begin with a summary of Q3. Are you happy with the credit growth, liability franchise margins, and the progression also in the NPLs?
First of all, I want to say that I'm extremely satisfied with the operating performance of the bank in this quarter. And, we have seen healthy growth in advances, in deposits, in core fee income, and overall operating profits across all businesses of the bank, leading to actually an operating performance such that the operating profit of the bank for the quarter came out at 47% over last year. Actually in terms of the fundamental operating sort of parameters of the bank, the franchise is growing from strength to strength. So that is very satisfying. And and in all parameters, including CASA improvement, cost income ratio improvement, and so on and so forth, margins have been at an all-time high at 4.57% net interest income margin. So the only thing is that we are sort of seeing the play out of the recognition and provisioning around a certain portfolio of corporate accounts, which we have previously identified, and we have sized that portfolio, and we have to go through the motions of seeing how they play out in terms of recognition, in terms of provisioning. So we have sized it. We have also indicated how we will deal with it, and we are doing it exactly according to our plan. So some of it we took last quarter. Most of the balance we have taken in this quarter. There will be a tail that we will take in the fourth quarter, and hopefully after that, we will put it behind us, because that is specific, that is identifiable, and that has been sized. And we are trying to take aggressive provisions there, much more than the regulatory requirements, such that if anything, there is future upside and no future downside. So that's the way we are going about it, and that's something that is more an execution item. And from an outlook perspective, we have not seen any further deterioration, if I may say, in our asset quality position. So that is positive, and that is also gives us an optimistic perspective in terms of our future outlook and performance.
Okay, could you also walk us through the movement in the watch list, BB and below grade investment book? What kind of provisioning have you taken for the 1,800 crore watch list?
See, the specific stressed accounts that were identified, the handful of them, that portfolio was sized at approximately 1,800 crores. We took 800 crores of NPA recognition last quarter. We took approximately 700 this quarter, and there is a small amount of tail, as I mentioned, that is left, which is not yet reached that level of recognition. It's not an NPA, and so, but that's the we have taken aggressive provisions, as I said. We've already provided between 45 and 50% in most cases, and that's about the levels at which we feel that we are very safe and we should not have to take more provisions. As for the rest of the portfolio is concerned, it is largely in the BAU space, and our total SMA2 position in the entire balance sheet of the bank is approximately 37-38 basis points, which is a very modest number, and we don't see, like I said, any material deterioration, further deterioration in the corporate portfolio, and we see a very stable portfolio on the retail side, which is our card business, our micro banking business, and our LAP business. In fact, in some respects, in the LAP business, we are actually improving the asset quality of our business. In micro banking and cards, it is stable, even though the environment has suggested that there may be some pressures in certain segments on the retail side. But frankly, the way we are managing our portfolio in a very proactive manner, and also the fact that our advances on the retail side are extremely well diversified across 24 states and so on and so forth. So there are no concentrations, and and we constantly, if I may say, manage, monitor that portfolio to make sure that wherever we see even the slightest bit of uptick of any kind of risk, then we deal with it swiftly, and so on and so forth. So that's the position out there.
Sure. And given that you've already provided 1,500 crores out of the 1,800 crore watch list, can we expect slippages as an asset quality to normalize back to the 2018 levels, given that the stress build-up now is minimal?
Based on our previous commentaries and also repeating that now, we have said that there are some remaining provisions to make in the current last quarter of the fiscal. So to exactly answer your question, we will reach BAU or a normalized rate of business operations and profitability from the first quarter of the next fiscal. So while the fourth quarter of this year will be significantly better, obviously, because the level of recognition provisioning required is much less, but it will still be below the normalized levels.
Right. Mr. Ahuja, on the positive side as well, if we look at the past 12 months, how will RBL Bank look, especially since you've raised capital and have strong tier 1 capital as well? What should our viewers, your investors be excited about?
Yeah, our tier 1 capital is in excess of 15%. Our total capital is in excess of 16.2% in terms of capital adequacy. We are in a comfortable position. We can maintain a 25% plus growth over the next 3 years without the need for further capital. We do expect to operate at approximately the mid-20s in terms of future growth year on year. And yes, a significant part of that will come from, more than 50%, I will say, will come from the retail side, and little under 50% will continue to come from the wholesale side.
Right. But your deposit growth was a bit low this quarter. How is the liability franchise shaping up, and what are your plans to make this stronger?
So the liability franchise is doing extremely well. Even in this quarter, the deposits grew well. The fact of the matter is, in this particular quarter, we had an LCR of 164%, which suggests that we were maintaining significant excess liquidity. We have been basically keeping a stance of maintaining excess liquidity through this period where the overall macro environment is somewhat vitiated. But the liquidity position got further enhanced because of the significant capital raise that we did, which was 2,700 crores. So really speaking, it's not been an issue. So we, in a sense, some of the bulk deposit business that we do, we toned that down and focused more on retail. So with that, the overall deposit growth, it could have been better, but we sort of managed it such that, we just don't generate high cost liquidity for no reason. And but the CASA bit grew 31%. So therefore, there was further improvement in CASA even in this quarter, as has been the case in the past several quarters. We've demonstrated time and again a very healthy liquidity growth, a deposit growth, and an even better improving CASA position quarter on quarter. So which was the case even this time, as I said. So we are confident that our, basically our liability engine continues to roll well. We've said that we continue to invest aggressively in franchise and branch expansion. We expect to close this fiscal year with almost 400 branches and add at least 100 next year also to reach at or above 500 branches. We do believe that along with all the technology that we use in customer and liability acquisition, it's a high-tech, high-touch sort of approach that works best. So expansion of physical footprint, especially in catchments where we've seen very good potential. Further densifying, intensifying that, is very beneficial. And that's the strategy that we are following. So we continue to invest in the franchise, and that's the way to go.
Mr. Ahuja, pleasure speaking with you. Thank you so much for taking the time out and